News trading is usually a customized technique of trading that takes advantage of the volatilities that take place during the release of high-impact news. Every major economy produces its economic indicators, including the gross domestic product, retail sales, consumer price index, short-term interest rate, and so on. Routinely, and many economists will attempt to forecast the outcome of these releases. Through combining these estimations and averaging them out, we now have what is known as consensus expectations. News trading normally takes the forecast numbers, or consensus expectations, and compares it with the actual release figure from the official sources, and if the prediction is incorrect by a wide margin, market will answer promptly. And by zeroing in your trading on this shock, news traders can minimize the time put in trading, the risk connected with investing, and lastly, boost the potential for earnings along the way. Surely, in order to fully understand news trading, we need to build up your personal forex strategy. It is important to comprehend the assumptions of news trading prior to exercising this sort of trading, because when with anything in life, news trading is not absolute, and there is a margin for error because the market could also be driven by other causes such as the risk sentiment, order flows, long-term and short-term fundamentals, and let us not forget, the technical approach of the foreign exchange pair. The first presumption in news trading is the fact that market is at equilibrium. Basically, it signifies that market has already priced in everything that has happened and will occur up to the point of the news release. If the news release turns out to be a shock, then the market should fix itself in the correct direction and achieve that balance again. For example, when the news is positive for USD, then we can expect United States dollar to gain after the news, so we ought to purchase United States dollar. The next presumption in news trading is the fact that market always exaggerates in its changes. Compare it to the definition of snowball effects, as when market starts to push, traders will want to joining in the actions, therefore causing the market to overmove. This really is rather correct, as we can repeatedly see the currency market driven by high-impact news, oftentimes for hours or even days to weeks. If that is not regarded as market exaggeration, then quite likely absolutely nothing is. Last but not least, news trading assumes that the market will move when a certain level of surprise is reached. Certainly, this so-called shock level is based on historical stats, but the presumption is the fact that if for a particular news event, let us say the interest release, varies from the forecast by 0.25%, then the market will move 100 pips minimum. Therefore, let us say that if the ECB, or the European Central Bank, releases its interest rate at 2.00% where the market is expecting a 2.25%, we should see traders selling the euro quickly by at least 100 pips. As a matter of fact, if this ever takes place in the real market, it is my opinion 100 pips is probably on the lower estimate. News like that could move the market by 200 and even 300 pips easily.